All right, good afternoon. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and I am here with Claudia Sahm. She is the creator of the Sahm Rule, former Fed economist, and now chief economist at New Century Advisors. We also have today John Leer. He's the chief economist at the decision intelligence company Morning Consult. And we are here to break down what we see in the Fed statement, which is forthcoming in just about 5 minutes. I think it sort of goes without saying that it is highly, highly unlikely, darn near impossible, that the Fed will actually move the policy rate today. But we're hunting for signals about how Jerome Powell is thinking about what has been sort of you might say a difficult quarter for inflation data. And we are also looking for signs of how the Fed is thinking about potentially tapering its quantitative tightening program, whether or not it may change the cap on Treasury roll off here. So let me turn it over to Claudia Sahm. Claudia, what is the potential news here today in your mind?
Hopefully, there's no news. I think we've been watching the data. The Fed's been watching the data. Inflation has been a disappointment, right? January, through March has been a disappointment. We all know that, right? So Powell doesn't have to come in and go. It's really tricky because he wants to be more cautious, right? Every meeting, December to January to March, there should be a progression of more cautious, right? But the trick is not to overdo it because the markets, and I think just, in general, like, hey, we should all be more cautious. So a lot of that's already priced in. So he has this very, like a tightrope of don't want to sound too pessimistic about a cut potentially this year, or cuts, and also not to sound too optimistic. So it's a really tricky balance, and yet the Fed is really good at kind of saying nothing, right? So that's it's kind of my hope, but it's going to be more pessimistic. He is going to weave in. We got the job opening and labor turnover survey today, and that did balance out some of the economy's running too hot because it's moderating. So it's going to be interesting.
Right, fair enough. Okay, so Claudia Sam uses the word cautious, John. It does feel like we're sort of in a holding pattern here, because at the end of 2023, we were all looking for rate cuts. In 2024, we had a series of really 6 or 7 pretty great inflation reports, and we thought disinflation is here. It's looking good. All systems are go for 2024. Then 2024 arrives. The first 3 PCE reports of the year have been not great. You look under the hood, there are a lot of ways that we could make excuses for it, but the Fed, I want to say, is a conservative institution. They're not for making excuses, even if Jonathan Levin is. John, how does how are the American people going to deal with an environment in which interest rates are potentially on hold here for another 3, 6, 9 months?
Well, you're exactly right that there's been a lot of whiplash, and I think to some extent, markets got a little outside of them, ahead of themselves. They saw maybe what they wanted to see, which was, potentially 4 rate cuts in 2024. What we've seen in our own data, just measuring the sort of the pulse of the consumer every day, is that whiplash has in fact translated into elevated levels of volatility as we think about how people feel about the economy, how people feel and what their inflation expectations are. And so, it's not nothing to have a elevated sort of volatility, both in financial markets and expectations coming from the Fed. I think that it does in fact weigh ultimately on consumers and creates that period of uncertainty that we're in right now.
Yeah, yeah. All right. Well, so we're heading into the decision here in about 5 seconds. We'll give it to you when it hits. And there you go. So the policy rate stays unchanged at a range of 5.25% to 5.5%. The headlines that are hitting now are the Fed says lack of further progress toward 2% goal in recent months. That is certainly understandable. They're not saying it got worse, but lack of further progress is the way to think about it. The Fed cuts Treasury runoff cap to $25 billion, keeps the MBS cap at 35 billion. So there you go. The Fed then slowing the pace of balance sheet runoff starting in June. So there you have it, Claudia. That seems to be the news to start with. The stock market is moving up a little bit on the back of that. Help unpack that for us. You know, we were just talking about how the inflation data hasn't come in great. The Fed is essentially on hold. Why then do they think it's appropriate to lower that cap of Treasury runoff to $25 billion, do you think?
The Fed has been clear for some time, if not from the get-go, that the balance sheet, what they're doing with the runoff, is separate from how they're thinking about the federal funds rate and the interest rates. Right. And so they have the fact that they slowed the runoff tells us absolutely nothing about when that first cut might be. Right. This is just them drawing down the balance sheet. I think we should think of it as more of a mechanical, and also the Fed wants to get out of this business. Right. And so they're going to do kind of slow and steady. We're not going to have every meeting a revision to how they're changing, the balance sheet runoff. And that's appropriate to get out of that business.
Okay. All right. John, any initial reaction to this this move to taper QT? Good news,
I would
bad news,
echo
neutral?
largely, I think, what Claudia said. They've sort of telegraphed this sort of progression for the last few meetings now. It is interesting, when you go talk to folks in Wall Street, they often do conflate, I think, Fed funds rate and the Fed balance sheet. I think that's Claudia's distinction there is an important one.
Sure. Okay. Let's dig into the set of facts that this Federal Reserve is actually dealing with here, Claudia. So what's been tricky, as I again laid out, we had a great series of reports at the end of 2023. And when I say a great series of reports, you were basically talking about core PCE coming in at 0.1s and 0.2s, right? Which ends up annualizing to something consistent with the Fed's 2% target. Here we are in 2024, and you're seeing we've had 2.3s and a 0.5 at the very start of the year in January. Under the hood, though, there were some interesting dynamics going on there. Should we be taking, a lot of signal from things like the lagging shelter component, B, things like motor vehicle insurance, motor vehicle repair? Are these telling us anything actually about the type of inflation problem that we may have and whether or not it's likely to linger? What's your assessment there?
So what I think we should read out of this, I have opinions. Those really aren't the relevant ones, right? And everything is on. And this is what in the statement I find very important. It's how is the Fed interpreting the data? As you said before, the Fed's not going to make excuses. They're not going to slice and dice the data. They're going to try and really figure out where the underlying trend is. I find it extremely not comforting, but I fully endorse the idea that they said we've seen no further progress, right? Because that is a very important interpretation in that they are not, and there are definitely people out there in markets, and we should have all views on the table, who have said inflation is accelerating. Like, we're not just making no progress, we are undoing the progress from last year, where that was a head fake. So the Fed is not taking that stand. They're very much in the wait and see, I mean, I think that will probably come out of Powell's mouth multiple times in just a little bit. And I think that's appropriate because, like you said, there's a lot going on under the hood. In general, there's a lot going on under the hood in this economy that has been very confusing, right? So people are trying to look at the data. I do think shelter it's just been grinding. January was such a disappointment, but we know from like the new tenant rent data that's also coming out of federal statistics, it's like the pig in the python. Like this thing should eventually turn down. We've been disappointed at how slow. One thing that's concerning about that is there is no interest rate. There is no federal funds level that could go back and cool off demand in 2021, 2022. Right. So doing monetary policy off of inflation that is very much driven by shelter is a pretty risky game, particularly as the labor market slows. So it's important to have these discussions, but the Fed, a word that won't come out of Powell's mouth today is transitory. Right. You could say like shelter is there, but it's coming down. That motor vehicle insurance, the motor vehicle repair, those are some echoes from COVID, labor shortages, a lot of things that have worked themselves out. They're going to come down in all likelihood, given what we know now, but we don't know when, and the Fed is not going to lean on that. And yet they didn't do like a springboard off of it and say things are getting worse again.
For sure.
So,
Okay, John, I want to get your response to
Well-
this, but first, I just wanted to point out that I did put up the strike through version of the statement for people, and I just wanted to underscore the key points so that our audience can understand exactly what Claudia has been talking about. So we see in the blue and the red here that the Fed has taken out their editing pen. The FMC has taken out their editing pen this meeting. And so they write that economic activity has continued to expand. That of course is true. First quarter was another pretty good quarter, although it wasn't as strong as the previous quarter. That was sort of for idiosyncratic reasons. Consumption remained relatively strong. The Fed points out in recent months, there has been a lack of further progress toward the committee's 2% inflation objective, exactly as Claudia told us just there. They do still believe that they say the committee judges that risks to achieving the employment and inflation goals have moved toward better balance over the past year. They had previously said are moving into better balance. They are now saying sort of past tense. They are, employment, stable prices. We're in kind of a good spot there. And then at the bottom, the only other place that they took out their editing pen was this guidance on what then is going to happen with the Treasury runoff. So, John, what is your take on all of this funkiness going on under the hood of the
I just think
inflation
folks,
reports?
over
Do
the
you
course-
trust them, and what do you think the Fed is making of them?
I just think over the course of 2023 and 2024, a lot of people have played this game where they go identify a particular category that looks to be anomalous, and they say, "Oh, let's read through that and look at some true underlying measure of inflation." And sure enough, that maybe they're right, that does sort of dissipate, and then it pops up somewhere else. And so I think it's just a very dangerous game to play. And in particular, if you look at the inflation picture, but also just the broader economy, we have still really strong, in aggregate, strong measures of spending, a really strong labor market. It would be different, I think. I would take a different approach maybe if I felt like the consumer was teetering on the brink of collapse, and maybe you really weren't going to see a readjustment of spending. That's also something we saw, right? We saw really dramatic reallocation of spending, initially away from services and then back into services in a really big way. Some of that reallocation, I think, is probably more secular than cyclical. And I think we're still trying to figure out what that kind of looks like on a go-forward basis.
Okay.
Yeah.
And as we do try to understand where trend inflation actually is, how important is something like the employment cost index, Claudia, which we got an update on I believe it was yesterday or the day before,
Mhm.
certainly this week.
Yes.
And it told us that the employment cost index, sort of the gold standard of measures of compensation growth, it increased 1.2% sequentially on a seasonally adjusted basis. Now
Mhm.
that's not a ton, and there's a lot going on under the hood there as well. But you annualize that, that's 4.8%.
Mhm.
Some people have argued that that's just not consistent with a 2% inflation, even if you are relatively optimistic about productivity. How do you square our inflation goals with what we're seeing in wages?
Well, first I'd say, thinking big picture about 2023, right? And this just underscores how we need to be looking at the data potentially in a very different way than in the past cycles. So we had very strong growth. I mean, GDP, consumer spending, inflation adjust 3% for the year. I mean, that is without a doubt above trend, right?
Mhm.
And at the same time, we saw massive disinflation. Okay, those two things are not supposed to go together. And we saw wage growth, and there's got lots of different measures, wage growth that was well above pre-pandemic pace. Okay, so normally you'd look at, if all I told you was the wage growth and the GDP and where the inflation started, you'd be like, you ain't getting inflation down, or we're going to go into a recession to get it down, right? And we saw something last year that tells us this time is unusual, if we hadn't already figured that out. And so then it's a question of what's happening on the quote unquote supply side of the economy, workers coming back, productivity being higher. If productivity is higher, and we've got some measures, this is really, it's harder than even wages to measure. The productivity that really can support a wage growth that is higher than before the pandemic. We don't know how much higher and how much pressure it's putting on, but we shouldn't be as worried. And earlier in the year, Powell said we no longer think that we must have below trend growth to get inflation down. Right now, it could be the regular rules come back and apply now, right? Like just because we had supplies, it doesn't mean that that's where so we should not be cavalier about it. And yet, even before the pandemic, the relationship between wages and price inflation, like, was not that strong. Like, it's very intuitive, and certainly for some businesses, they have to pass it through. But in terms of like the overall picture, it's there. But I think we've potentially, and this is the Fed, right? I think it's just been talked up to a place that is maybe beyond, and yet it is high, right? And you don't want to rest on productivity, and this could be an inflationary piece still.
But can I ask you, Claudia? So I think about 2023, and a lot of that story was some of the story on the labor front, at least, was supply of workers coming back in and the immigration front. And so I guess as I'm looking out into the future, I'm trying to figure out, well, if we're focused on that supply side of things, where is that additional supply going to come from that's going to allow us to, um, continue to expand without seeing some inflationary pressures pop up?
Right. So, there's a debate, and it's hard to figure out exactly how many immigrants are coming into the country for a lot of different reasons. The Congressional Budget Office estimates that 2 years ago we had 2 million coming in, last year 3 million, and another 3 million this year. Three, it was 1 million before the pandemic, like in kind of average years. So we've got probably another push this year, but it wasn't just immigrants. We had women coming back. We had, there were other marginalized groups that a great labor market we're bringing in. I think there's still a question. A really important question is how much of the kind of COVID disruptions in the economy have worked themselves out. Like we did a lot of them last year, and how long does it take the labor shortages being addressed even just last year to show up in prices and inflation this year? And then how much do we have echoes, right? Like the motor vehicle and related, it's like the supply chain started healing in 2021, and then used car prices, had come up and come down, and now you like vehicle parts, and then we're in maintenance and insurance. So you could look at that and say, and I have said, that these are echoes of COVID, but that doesn't have to be what that is, right? If that's not supply driven, then you have this question of, okay, we've got too much demand.
Yeah.
I, So looking at the labor market specifically, though, since we were on ECI here, you know, I'm having a hard time understanding exactly what's going on with these different forces because we just said, wage and compensation pretty strong, unemployment very low, and yet consumers, households continue. We've declared the end of the vibe session many times here on this program, but consumers continue to feel, relatively bad about their situation, and even in some surveys are mentioning frustrations with the labor market. Where's that coming from? What are you seeing, John?
Well, I think there's two things to do, and one is to look at the level. And look, we had a really strong shock to the economy in the form of the pandemic, and then inflation after that. So those are really sort of long-lasting, severe shocks. What has been pretty impressive to me is actually how remarkably consumers have responded and rebounded really in the first quarter this year. So, that period of real wage growth that kind of started roughly halfway through 2023, it took a while for that to translate and start being reflected in some of the sentiment data. But I think it's there in a pretty big way right now. We've seen consumers try to start replenishing their savings across the income spectrum. And so I think this is actually kind of a Goldilocks moment. I mean, there are still obviously many, many folks who are on the wrong side of the inflation picture here, but pretty relatively low, relatively low compared to last year, the prior year's price growth, and then continually strong wage growth. So you get positive real wages is the story, I think, of 2023 that just is not discussed quite enough.
Yeah, is it possible that there's a generational thing to, the bifurcation in this economy, John? Because, I look at it and I say, you know, on average, obviously America is a big, complicated place, but on average, if you own a home and you're employed and you've enjoyed slightly positive real wage growth, you own a home and you're invested in the stock market, you've probably done okay throughout this entire period. If, on the other hand, you're just trying to get a foot in the door at your first job, you have not been invested until now. Maybe you're thinking of chasing this rally in risk assets and wondering if it's actually a good idea, and you do not own a home. You're paying an extremely high ratio of your income for rent, and you're realizing that it could potentially be months or years until you can become a first-time home buyer. Is that creating sort of a bifurcation in this economy of haves and have-nots?
Well, there certainly is a bifurcation, I think, across a couple different dimensions, but maybe the distinction I would make is that those older folks, don't have much extra time left, or relatively less time left, to go earn wages at higher rates. And so I think that's one of the reasons that we see younger Americans in particular, but really globally, we see younger folks kind of look through and be dismissive of inflation as it relates to assessing their own personal financial condition.
Okay. And you also provide a lot of interesting intelligence on the political outlook over there at Morning Consult. How is this translating into what we may see in November?
Well, we know now that actually I just looked at this in let's say 6 of the swing states, sentiment is not back to where it was prior to the 2020 election, but trending in a very positive direction. And so I think the question right now is sort of, what is the next few months going to look like? One of the in aggregate, we have seen, and I think I discussed this earlier, just elevated levels of volatility in sentiment, primarily driven by, we had the VIX shot up earlier in April, stock prices moved dramatically. There's a lot going on the geopolitical front that could change the outlook very, very rapidly. And so I think a lot of folks are sitting at home, basically on the edge of their chair, waiting to see what's going to happen next.
Okay. All right. So here we are. We're 10 minutes out from the Powell press conference. A lot of people think that that's the main development of the day. Certainly, the price action on Wall Street would suggest that's the case. That's where a lot of the big moves have come from typically. Claudia, you got into this a little bit at the outset, but what would constitute a successful Jerome Powell press conference here?
The markets don't move. Or if they do, they kind of wiggle around and then settle back. The markets have absorbed a caution, a pessimism. And maybe it's too far. Frankly, I think it's too far. And yet September, which I think could be, on the table, live options still get you towards 2 cuts, 5 CPI releases before that.
Right.
Like, why in the world would try to fine tune? Why would Powell try to fine tune the markets, which is actually impossible, right? As soon as he starts like trying to get fancy, markets will start bouncing around. And but he does need to reinforce, hey, and I think the statement did this. We see it. This is not good. We have not made progress, and we told y'all we need to have further progress before we cut. So I think he's going to try and keep a very measured tone. I had said earlier on Bloomberg, every time he opens his mouth, it's a downside risk, right? Because the markets, and we've seen this year, and I agree with John, like they were way too optimistic, and now I think they're probably way too pessimistic, or at least too pessimistic. And there's some individuals making the case, well, this is Powell's fault. Right in December, he was so exuberant, and I was just like, I didn't hear 6 or 7 cuts. Like you wanted to hear 6 or 7 cuts, you markets. And so it's like, I worry, and I think we've seen it this year, maybe more than usual, but it always happens. People hear what they want to hear, right? They're listening for what they want to hear. And that makes it really hard for the Fed because Jay can control what comes out of his mouth. He cannot control what goes into people's ears. Right. And so this makes a very tricky dynamic. I think, like I said, I thought the statement is, they're walking the tightrope, but he's set up and he is among the FOMC, the very best communicator with markets, but nobody's perfect.
Right. So I put up the yield on the 10-year note as you were talking, just to sort of underscore the point, and I'll leave it up as we head into the press conference here. But for what it's worth, these have been pretty muted moves so far. You always sort of see this little whiplash when the statement comes out. That's just machines kind of doing their thing. But all told, after the big announcement about QT, the yield drops maybe 2 basis points. That's basically nothing in this world. And we'll see what they do while Jay is speaking. But Claudia, if I'm understanding you correctly, should Jay just keep doing what he's doing? I mean, I agree with you. I think he's been doing a pretty good job. I think he comes off as a straight shooter with markets and with the American people. And I think that a lot of the quote unquote volatility attributed to him is really just, the markets doing their choose your own adventure kind of thing. But should he keep doing what he's doing? Should he veer from his policy of just being transparent with the American people so as to manage, the market's like volatile tendencies in some way?
Yeah, no veering today.
No veering.
I'm not even sure that's in the Fed's vocabulary. No, there's been a lot of volatility. This has been a rough ride for everybody, including markets. One thing Powell, and actually from the very beginning of the pandemic, he has been a steady hand, right? Has not sugar-coated things, but it's kind of like, we're going to get through this. We got the eyes on the prize here. We're going to keep going. And stories should evolve, right? The data has been a surprise this year. So you wouldn't want Jay to come out and say what he did in December, because we're like, whoa, can we go live in your world, right? Like things have changed. And so there should be this progression, reinforcing. And one thing that is somewhat unusual from this Fed, and I kind of understand it, they are hyper data driven. Everybody wants Jay Powell to tell us today when they are likely to cut. Jay Powell does not know, right? He doesn't, because it is very data driven. And one thing he can do at these meetings is help us see how the Fed parsed the data. He did more of that last time. Like, tell us what you see. So that helps teach us to see how the Fed sees, right? Because it's the data that are going to drive this. But we want them to drive smoothly, no veering, right? So Powell can help with that. And I mean, he's been doing as best he can, and the Fed always gets blamed. That's okay. They're used to that. It's just, stay the course on the policy. That's what we want from them.
Well, and when they say they're data dependent and the data shows some volatility or sometimes moves in a direction that's inconsistent with expectations, I think it shouldn't be surprising then that maybe folks attribute some of that volatility to Chair Powell. Although, again, I think, as Claudia mentioned, he's just following the data.
Right.
And the data has been different than a lot of folks expected it to be, to say the least.
Yeah, no, and it is a risky way to do monetary policy. Like, I don't agree with the hyper data dependent, but I totally understand, and it may be the best thing for them to be doing. Monetary policy works going forward because it has to work through interest rates and through decisions. You are really rolling the dice if you're doing policy based on what happened 3 months ago or 6 months ago. So they have to be very careful with what they're doing, but this is the path they put themselves on, and this really may be the best we can do.
I wonder that sometimes. I thought I was out on parental leave in later 2023, so I was watching a lot of Bloomberg, and people would come on and they were Bloomberg surveillance. They were all talking about imminent rate cuts, and I started thinking, well, I think they're just taking a line, core PCE, and they're just sort of drawing a trend line straight down. We're not there, and so there's some of that too of just needing to actually wait for the data to come out. And if it is in fact really different than folks expected, then that drives a different reaction function.
Okay, but so the Fed says that the Fed says today that the risks are relatively balanced. As we wrap up here, about 2 minutes to go before Jay's press conference, do we agree with that? The question here is if we do think that this is in large part, the lags playing out in housing and insurance and other areas like that, why not trust the forecast? Why take any risk at all with the real economy and the labor market? Why not trust the forecast? What do you think, John?
Well, I think we mentioned earlier, those forecasts are often built on some assumption about the nature of the underlying economy, the cyclical component versus these longer term trends. We have seen many ways in which the pandemic disrupted those longer term trends. And I think we continue to experience sort of second and third order effects. So if there were ever a time to not rely on forecasts, actually now I think would be that time to be highly skeptical of forecasts.
All right. And Claudia, same question to you. I mean, why take any risk at all with the real economy, or do you just think I'm being too sanguine and trusting my story too much about the lags in the insurance and the housing and so forth?
Yeah, the Fed is the Fed, right? Like, they got to get inflation down to 2%, and they're going to be focused on that. I take huge comfort from the fact that they, and not everybody is doing this, they are talking about the risk to the real economy, to the labor market. They're putting more on, hey, inflation could pick up or not get down to 2, but they see what they should be seeing is that we have a labor market that has largely rebalanced. it looks pretty good. There's some things we need to, keep an eye on, and yet rebalanced, kind of back to a normal place, is the last thing we see before the bottom falls out. Right? Like you can kind of stay in the glide path and it's sustainable, but the Fed is putting pressure on the economy, on consumers, on businesses with these high interest rates. So the fact that they are cognizant of, hey, we're within a percentage point of our target on inflation, so we should really be paying attention to any kinds of cracks in the labor market. And the labor market is such, once that snowball down gets going, you have an avalanche, right? Because it's very hard to stop a recession once it's started. So I think I have a lot of respect for what they're doing. This is very hard, and yet they're at least thinking through this, but they are taking risks. I mean, we all are.
All right. Well, we have to leave it right there so people can get over to Jerome Powell's press conference. Thank you very much, Claudia Sahm, New Century Advisors, John Leer, Morning Consult, and thank you to everybody for tuning in.
Great. Thank you.
Thank you.